warahmatullahi wabarakatuh. Hi, I am Yasara Ulfah from Accounting Department, University of North Sumatra. Today I'm gonna explain about Accounting Advanced, Chapter 1, entitled Accounting Firm Formation. Before we start, let's see the learning objectives. The first, describe the definition of firm characteristic, and firm forms that are encountered in practice. Second, knowing and understanding the strengths and weaknesses of the firm and the various reasons why the firm is one of the choice in the form of a company. Third, understand and compile a journal to record firm formation transaction either by continuing the books that have been made in the previous company form or by creating new ones for the firm. And the fourth, prepare a report on the initial financial position after the firm is formed. So, the first topic is the definition of firm. Etymologically, firm comes from the word fellowship under firma, which means trade union between several companies. Firm can be defined as an unincorporated association of two or more individuals to carry on as co-owners a business with the intention of dividing the profits among themselves. Each member in this partnership has full responsibility for the company so that the capital needed to establish a business entity also comes from the joint venture of all partners involved and contributing to it. The establishment of a firm is also very easy. It is enough to make an agreement between the parties and then register it at the state secretariat. The next topic is firm characteristic. First is mutual agency. Each firm partner is a representative or agent of the firm for their business purposes. Thus, any action taken by partner, as long as they are still within the normal framework of the company's business, are actions of the firm. Limited life. The lifespan of a firm is limited by the things that are in accordance with the contents of the agreement. If the reality in the field turns out to be no longer in accordance with the agreement that has been made, then legally the firm is considered dissolved. For example, a resignation of a partner, a failed partner, etc. Unlimited liability. The responsibility of each partner is not limited to the amount of the capital they have deposited. This means that if the firm's assets are not sufficient to cover its debt, then the partner's personal assets will also become collateral or means of repayment of firm's debts until everything is finished. Next, ownership of an interest in a partnership. Even though the firm is an association of partners, and of course the personal characteristic of the partners will be attached to the firm, but all the assets invested by the partners have become common property and no longer private property. Last, participation in partnership profit. By joining the partners in a firm, the partners are also entitled to receive or participate in the profit sharing of the firm. Next topic is reasons for choosing the firm. First reasons is capital raising. With the form of a firm company, the owner of the company consists of more than one person, and thus the number gathered will certainly be more because it is provided and comes from several people. Second reason is easy forming and dissolving procedure. Partners who agree to establish a firm are sufficient only to make a deed of agreement or agreement between them, and with that deed the firm's company has been formed. Likewise, if there are things that are not in accordance with the contents of the agreement, the firm can consider it dissolved. The last is attachment to the personal characteristic of the owner. The condition of a firm is very dependent on personal characteristic and the ability of the owner in managing it. Thus, the personal advantages inherent in the owner are one of the important keys to the success of a firm. Next, types of firms. From the point of view of the business sector, there are two types. Those are trading firms and non-trading firms. Trading firm is a partnership, a company engaged in manufacturing and trading. Non-trading firm is association companies engaged in service such as law service, accounting, etc. The second, from a partner right point of view. From the allied right corner is divided into public firms and limited firms. Public firm is a firm which all members or partners have the same right, and limited firm is a firm whose members do not have the same right. We move to the next topic. The next topic is issues from the firm. The first issue is, although from a legal point of view, a firm is like an individual company which is not a separate entity from its owners, from an accounting point of view, a firm is a separate entity from its owners. Second, in practice, many firms operate using an accrual basis accounting system, but there are also some that use a modified cash basis. Third, many people view that unlimited responsibility is a form of firm weakness. Fourth, in this type of limited firm, the liabilities of passive partners, or called silent partners, are not only limited to the amount invested, but they are also limited to taking some action in the management aspect. The last topic is the accounting form formation. The establishment of the firm begins with the payment of capital from the owner, so the accounting process in establishing this firm begins with the recording of investments by its partner. There are several alternatives to establishing a firm. First, the firm was founded by amalgamation of individuals. Example, on April 1, 2016, A and S agreed to form a firm. Person A invested 20 million rupiah, while S invested in vehicles and equipment worth 25 million rupiah and 5 million rupiah respectively. The records are A's investment, debit cash 20 million, and credit A's capital 20 million. B's investment are vehicle in debit 25 million, equipment in debit 5 million, and in credit S capital 30 million. Then the AS firm statement of financial position is as follows. In here of A and S, you can see here there are two records of this incident. The first, the records of company S are passed on to become the record of AS firm. A's investment in debit cash 20 million, in credit A's capital 20 million, and S investment in debit S capital 2 million, and in credit equipment 2 million. Next, in debit cash 5 million, and in credit S capital 5 million. The firm was founded by combining individual companies. For example, from the example above, it is known that A is also the owner of an individual company, and at the time of establishment of the firm, the statement of financial position is as follows. Financial position you can see here. A new book for the firm is opened, but company A and S book are closed. Then the AS firms recorded are as follow. A's investment in debit cash 6 million, equipment 2 million, and vehicle 15 million. In credit account payable 3 million, A's capital 2 million. S investment in debit cash 7 million, equipment 3 million, and vehicle 25 million, and in credit account payable 5 million, and S capital 30 million. Company A's book is used for recording, so A's investment in debit A's capital 1 million, and in credit account payable 1 million. And next, in debit cash 5 million, in credit A's capital 5 million. S investment in debit cash 7 million, equipment 3 million, and vehicle 25 million, and in credit account payable 5 million, and A's capital 30 million. Are in the end of the presentations. If you have any question, leave the comment below, and thank you for your attention. Assalamu'alaikum warahmatullahi wabarakatuh.